Good afternoon, everyone who joined us today, depending where you're based. I'm happy to welcome you at our final episode of our global set of the seminars, online seminars. This year we were rather close with you because we were in touch and um, trying to discuss all the situations which were arising at the markets during 2020. And so this day we will make the final episode of our meetings in association with Andreas Bickel because we had a few seminars with him discussing how the economy is recovering. And today, this is almost the end of the year. It is time to make the reevaluation of your portfolios, of your strategies, in order to understand whether you are more or less close to reality. And it is a high time to understand what kind of forecasts we can make later on. So I'm happy to pass the floor to Andreas Bickel, who's the Chief Investment Officer of Blackfort Capital. Hope you all remember. So today we'll basically discuss all the results of 2020. We'll discuss what kind of things we can expect from 2021. What kind of economic outlook we had this year, how the economies are recovering and actually waiting for the third wave of the COVID. And actually we are going to discuss what kind of volatility will have supported by fiscal driven rally. So, Andreas, please join us. How are you doing today?
Hi, Lana. Thanks for the introduction. Not too bad. Markets are up. A bit surprising, to be fair, but markets are up. As already said, we are going to have a look what happened in 2020, but probably more interesting what might happen in 2021. We still favor and really urge that we see fiscal stimulus. This will have a huge impact on economic outlook. We have a big elephant in the room, which is COVID-19. And with that, probably a higher volatility going forward, excluding the sharp drop in March this year. So let us start with what happened this year. So if I look at bonds and equities, and I just take the plain figure, I can summarize global high yields, Asian high yields, US high yields delivered 5% and more. Wow, not bad. The same holds true for equity. Nasdaq more than 40%, S&P more than 15%, MSCI World more than 13%, and. Laggards where Europe, DAX, for instance, is flat. The FTSE due to Brexit is -10. Hong Kong due to the riots and the uncertainty is -3, while China A shares are up more than 20%. And the Nikkei has reached a 30-year high. However, we all lived through this year. And in March, we had a strong sell-off due to COVID, a lot of uncertainty. And since then, we are pricing in the future. We are pricing in hope. We are pricing in that in Q1, Q2, we will see a significant acceleration of growth. If that's going to happen, it's obviously completely open, but that explains why, for instance, November was the best November in the US since 1987. And in 87, we had the crash ages ago, I know, and the recovery in November 87 was almost the same level like we see today. but you cannot compare the two situations. We had a tremendous year till the beginning of November and had the best November on record. Therefore, one conclusion is probably the Christmas rally was this year in November. Top of it, we have seen gold rallying and now correcting, but still year to date we are up more than 20%. Promising, I would say, is copper. Gives you an indication for the industrial development, or at least the expected development. Oil, be it WTI or Brent, were down roughly 23-24% for the year. However, over the last 3-4 months, a tremendous rally, and with it, for instance, Russian equities recovered sharply and are now showing a very strong performance for the year. Year to date, in the currency space, the big theme is obviously the weakness of the dollar. Probably for next year, that will be the same. But this is also a crowded trade. There's another way you can look at what happened this year. It's a chart I found this morning. It shows you not the performance, but it shows you the inflow into assets. What was fashion this year? I mean, unsurprisingly, tech had a tremendous run. Gold had a tremendous run. Both had huge inflows. But we have seen as well, and we will see forward-looking, more of the cash theme. A lot of people hold cash. Cash is not giving you any return. Cash is jeopardized by expected inflation, and the holding of cash in most currency is not for free anymore. That's another way how you can see what happened in 2022. But obviously, the key question is what's going to happen forward-looking. I had this chart last time. However, I have added some comments. What we see is monetary stimulus, including the famous modern monetary stimulus. 62% of all treasury finance was bought by the Fed this year. This is already an astonishing high figure, but it overpassed the issuance. So everything that the American state issued, plus 613 billion, were bought by the Fed. So this is monetizing of debt. It didn't create inflation, and it didn't really create too much growth. The reason for that is what I've presented last time, balance sheet recession. So therefore, forward-looking, it is really key to see fiscal stimulus. The latest news from the US are that we are going to see probably this week, maybe beginning next week, a package of 500 to 1,000 trillions. That is between 3.5% and 6% of US GDP. And there is more in the pipeline. Both parties have agreed that they make two distinguished package. One is to avoid the fiscal cliff. Fiscal cliff, by the way, is the American way of saying we have to deal with a balance sheet recession. And in January, obviously, there is planned to be more stimulus, probably more on the infrastructure side, while this time it's more unemployment benefit. What did this all create? The velocity of money has dropped significantly. We are at levels last seen in the 30s, so last seen during the Great Depression. What's not shown, but obviously that's the mirror side of this chart, is this has also the result that the money around, so the amount of money is huge, but the speed is collapsing. Therefore, there is no recession. How was that solved in the 30s? There was no monetary stimulus. The Fed didn't have this instrument yet, and there was no strong belief in that. Therefore, at that time, there was fiscal stimulus, and during the Second World War and afterwards, it was accompanied by yield curve control. Sounds familiar. We have slightly different names today for it, but bottom line, the Fed is indirectly controlling the yield curve by the purchasing program, has deepened the yield curve by keeping the lower end at a very low level, and 10-year for hindering so far to rise above 1%. So very similar remedy, with one exception: the fiscal stimulus is not yet there where it should be. Another similarity which we have had in previous seminar, after World War II, the debt level was at huge levels, so 130% roughly of GDP. We are reaching that level, and probably we are going to overpass it. And the key question for forward-looking is obviously how we will bring down this debt to GDP ratio. I only see two possibilities. One is the Italian way, if you excuse. The Italian finance minister recently said he welcomes the rescue fund from the ECB. However, he also puts into the discussion that down the road we have to have a haircut in the debts in Southern European countries. So there's one way of restructuring debt. And the other one is financial repression, keeping for a very, very long time yields depressed, trying to push up inflation, which the Fed announced that the key goal is that we have an overshoot of the 2%, and that only on average we will see in future 2%. So and you inflate away this debt to GDP, at least in real terms. And last but not least, the Fed, the ECB urges their governments to start with fiscal stimulus. If you put all these ingredients together, it will take a long, long time, but it might be the only way without a haircut to put this figure down. Forward looking, probably it's more important what we're gonna see in terms of GDP growth. My belief, and the belief of the producer of this chart, which is in this kind is Barclays Research, but there are quite some others who have a similar opinion. The US is expected to reach the pre-crisis level next year, while UK, the European Union, are definitely not going to be there, even with the announced fiscal stimulus. China is already at the pre-crisis level. China is expected to grow more than 5%. My guess is 5.5%, but the key message is not the percentage by itself. It's rather that for the next year, China is probably to grow more than 5%, while this year, including the sharp drop in Q1, also this year, China is probably to grow around 3 to 4% year over year. The US is expected to grow more than 5%, at least from Goldman Sachs, some other strategists, and myself. Nevertheless, we have seen from the from the OECD, they have recently cut the global GDP forecast from 5 to 4%. What does this tell us? Basically, we don't know. Here you see the distribution of growth forecast for the US. So the consensus is around 4%. Goldman Sachs and one other are significantly higher. My guess is we will be in that area. And here you see the same for Europe. So Q4 is expected to be -2 to -4. However, this chart was produced before the recent announcement of the partial lockdown, and now in the Netherlands and in Germany, the full lockdown. So expect Q4 to be extremely weak, not so weak like Q2. And then the recovery next year will be muted. And therefore, the growth outlook for Europe is definitely muted to a certain degree. Q2, Q3, the market expects, however, something else. You see here real-time data from China freight shipping, or the freight index. And you see that in Europe, over the last 2 months, we have seen a parabolic explosion of goods shipped to Europe, but even to America, the figure has since the summer risen sharply. This shows us that probably the muted to negative forecast of the OECD will most likely be, like most of the time in the history, be beaten. Why I'm so optimistic? The China PMI data are at the 10-year high. All a major part of the purchasing manager indices are above 55. Just to remind you, that means we are in the acceleration phase. China is for sure behind the first wave. They didn't have a second wave, and I would argue there will be only a minor, mini, almost not to see third wave. Therefore, China is one of the key motor of the global economy for next year. But also the US, if markets are right and not forecasters, and you believe that the bond market tells you a better story than all the forecasters, you see that since roughly 2 months, we have seen a sharp steepening of the yield curve of the US. My guess is that the recession in the US is behind us, and we will see positive growth between 1% and 2% in Q4 and a better figure in Q1 next year for the US. This is derived of soft indicators, but also if I look at copper, I mean, in hindsight, you see the sharp rise in November. The sharp rise in November goes hand with the strong equity move. But the copper is not really indicating a significant slowdown, by the contrary. So market data tell me the future is probably brighter than the forecast. Today there was a review of our Swiss data. Switzerland is very small, but we are an open economy. Most of our GDP is driven by exports, and the figure was sharply revised down. I would say based on soft indicators, based on market data, we will see better figures, but the elephant in the room is this, and this chart is a bit sad because you see here the Spanish flu, the development of the deaths in the United Kingdom. Unfortunately, there are two messages. First, we have now, like at the time in 1920, a second wave with more death, with severe situation that most hospitals in developed countries are at the edge of breaking down. The healthcare system is going to break down. 2-3 months ago, politicians told us we have learned a lot. We are having it under control, and the future looks quite bright. Unfortunately, in this case, history is a guide for the second wave. What we all don't know is what will happen with the third wave. So if people were to use the vaccine which is available, it is more than fair to assume that there will be a very muted third wave. But if you follow the news flow, be it in the United States, be it in Europe, in particular in France, but also in Germany to a lesser extent, but in France, more than 60% of all people were answered when they were asked, would you vaccine yourself? No, definitely not. Having said that, we really don't know, including the expert for pandemics and people like us, managers of assets, strategists. We really don't know how the third wave will look like, and especially if we are getting the second wave under control. I mean, the answer is we will get it under control, but the question is, what is the price and in which time frame? Therefore, to position myself clear, I stick to the data driven by the markets or soft indicators, and I would argue that the economic side, and with it the returns for assets, will be quite promising in 2021. Why I'm so positive? Well, first of all, the amount of cash, that's the light blue line on the top, is still at an extreme high. The money flow into the government bonds and corporate bonds was ongoing the whole year, is ongoing since 3 years. That's the time frame of this chart. And equities, although they have seen a record inflow into equity products globally over the last 2 months, they are over 3 years flat. So over 3 years, there was net no inflow into equities. You see this, a chart from today, basically the same, a slightly different time frame. This time we are talking of 2 years. You see bonds had tremendous inflow. Cash had an inflow and was slightly diminishing over the couple of months since the first wave. But equities net over almost 2 years are still negative, and even the strong inflow over the last 3 months hasn't put us to a neutral level. So there is a lot of money on the sideline which needs to be invested. What the central banks have achieved is that, based on the figures which came out today, 18 trillion, this chart is 2-3 weeks old, we were at 17 trillion, so now we are 18 trillion of all global issued bonds give you nominal negative yields. We have seen up to this morning 190 rate cuts globally. This is amazing. Ray Dalio, which you might know, he is the co-founder of the largest hedge fund in the world, and he has written a book about the next decade, the rise of superpowers. He says 2 things. First of all, he, and I would strongly agree with that, he says forward-looking cash, and he means obviously dollars, cash is not a safe investment because investors believe that the dollar will keep its historical role as a reserve asset. However, he strongly disagrees with that. He believes that the next superpower, the next strong economic area will be Asia, in particular China, but not only. And therefore, the role of the dollar will diminish. It still will be a reserve currency, but it will diminish. And if you look at the yield, that's the yellow line here. So the real yield of the US 10-year Treasury bonds is roughly minus 0.9%. So if you hold Treasury, at the moment, you still get a positive yield. If you subtract inflation, you're already minus 0.9. And last but not least, you pay taxes on this income. And if you have it in cash, in most banks, you even pay for holding cash. So cash is not a safe asset. That's a key takeaway. And another one, to put it bluntly, is Tina. There is no alternative. You need to deploy your money. Where is the question? Well, today I've read 5-year government bond from Italy will give you a negative nominal yield. Italy. 10-year government bond from Portugal, 10-year, give you a negative yield. We can go on, same holds true for Germany, etc., etc. So safe corporate bonds are basically risky assets with a negative nominal yield. If you go to investment grade corporates globally, they deliver you a return of nominal roughly 0.4% with a long duration, bonds with maturities on average more than 6 years. So there's a lot of risk in it and a very little nominal return. If you go in areas where we invest in high yield, be it globally emerging market, we still get some return. So US high yield is roughly 4%, global high yield is slightly higher. Asian high yield depends a bit on the area, but is similar or slightly higher. Not shown, and we are not an expert, but local currency corporates from emerging markets deliver you probably 4 to 6% and the possibility to gain on the currency against the dollar. So if you are going to invest into corporate bonds or in bonds in general, you must unfortunately go down the risk level and invest in corporates in the non-investment grade bonds. If the Fed is going to do what they are telling us, and tomorrow there will be an update, that for the next 2 to 4 years, yields will kept at zero and they will intervene in the market QE forever. The risk for at least 1 to 3 years to invest into these low yielding, high risk assets is probably reasonable, or it's at least a way to get some returns for your cash. By no means we can make a value case, be it for this asset, be it for the assets which I will show you later on. They are all expensive. However, I have said this before, Etiardeni, a strategist, claims due to this monetary and fiscal stimulus, we have created an environment for the mother, as he called it, mother of all asset melt-ups. I prefer the term that the secular bull market is not over and it will die in euphoria. And I still believe that we have not yet reached that level of euphoria. So there is more room to go, although there is definitely no value around. Seasonality definitely speaks to put your money into equities. And if you believe that there is a correlation, like I do, between corporates and their equity, also in corporates. There are, however, certain risks, certain things which do concern me. You see here the same like before. So since Thanksgiving, December should be roughly 2%. America is now slightly down month to date. Europe, emerging markets are slightly up. And over the next 3 months, you can expect a positive return in 98% of all cases above 6%. But the risks are as follows. We haven't seen a correction, and there are statistics measuring who is always bullish, who is always bearish. The bears in November basically were wiped out. That's the red shaded area. Economists who are always cautious have also turned positives. And obviously the people who are normally positive, they stayed positive. This is, however, alarming. I would argue that correction is overdue, but this would be a correction in a bull market. Therefore, I would urge you, if you were to see a correction, to deploy money once it drops. Another reason which I'm on one hand positive, but on the other hand a bit scared, is this statistic. Roughly 92% of all stocks traded in the American Stock Exchange have now reached a level above their 200-day moving average. So more than 90% of the US market is now really trading in an uptrend and looks extremely bullish. However, normally that's an indicator which is before a correction and or a crash. I would not foresee a crash given all the stimulation ahead of us, but I would definitely assume that over the next 3 to 6 months, there must be a setback. This is another scaring part. You see here that the white bar, these are single stock calls, is at an all-time record level, never seen before. And the blue part that are puts is also showing you a new record level. There are two messages here. First, there is definitely a lot of euphoria, bullishness in the market. And second, most of this comes from retail traders, Robin Hooders. More than 20% of the stock holdings in the US is now held by retail investors. They call it damp money. We can argue, I mean, I would definitely not make here a case for Tesla, but if you look at the Tesla chart and you were invested the whole year and you had maybe invested 10,000, if you calculate your return, you get tears in your eyes. And Tesla will come into the S&P by the end of this week. So probably forward-looking, we could expect that Tesla might underperform once in the index. With that, let me share our view on some individual asset classes. Here I show you the US dollar against the euro, and I could also do this, the dollar in the DXY index. I expect the dollar to weaken further due to the intervention of the American Central Bank, but I must say everybody expects this. This is a risk to this forecast. However, the American government, at least the actual one, is interested that the dollar stays weak. This helps them to boost their already growing economy. WTI, or oil in general, I was personally surprised with the sharp move in November. I mean, from 35 to 45 in 1 month is tremendous. Oil experts expect forward-looking that the oil price might go above 50. Different to last time, I could say, if you were to buy oil ETN, so products which track oil futures, the rolling losses have minimized. So at the moment, you probably could profit from a further rise in oil if you were to buy an ETN. If you were to buy, obviously, a future, it's a one-to-one, but it's also a market-to-market risk, and you move quite a lot of money if you buy a futures directly. But most likely, due to cyclical recovery of the global economy, the oil price is supported. The risk to that is that the OPEC Plus has announced that they will, in February, increase their global production by 500,000 barrels a day. Having said that, the market rallied on that day. Gold is a tricky one. Gold, since we have seen several announcements of the effectivity of COVID vaccine, has sold off. It sold off to its 200-day average, has recovered, and as we speak, we are trying to overcome an area of 1850, 1880, or to retest the low. We think, given the outlook for money printing, given the outlook of a possibility of a pickup in inflation, gold should be a part of your portfolio, and gold probably will rise over the coming 2 years. And I've stressed now 2 years and not 1 year, knowing that this is far, far away. But the point is, gold correlates with negative real yields, which we have, but also with rising or falling yields. And treasury yields have risen to almost 1% and are now slightly down to roughly 90 bips, the 10-year. If the bond forecaster and the inflation forecast consensus were right, then we see higher yields next year, which would hurt gold. Personally, at the moment, I do not see that, but I cannot completely rule it out. So gold as an insurance in the portfolio should definitely play a role. I found this chart amazing. So you see a 2 months return. Maybe you remember I was positive on Brazil. Over 2 months, Brazil has risen almost 29%. I was positive on Asia. Over 2 months, it's still okay, roughly 10%. What's amazing is the third line, the Russell 2000, over 2 months has rallied. That's why 92% of all equities are trading above the 200-day moving average, while the FANG stocks, or more concrete, the Nasdaq 100, driven by the FANG stocks, has only performed roughly 2%. If we look at it over year to date, you still see Asia, Nasdaq are outpacing the rest of the world. Forward looking, I would strongly assume that we see a further continuation of cyclical stocks. So the third line is the Russell 2000 has catch-up potential. I would argue that Asia has potential, and I mentioned Ray Dalio. His conclusion are that not only will the power, the economic growth go from the US to the Asian area, but also the investment opportunities. Where is the big question mark is Asian tech or US tech or both? At the moment, I would bet on both. But this is obviously up to discussion, and it really depends how the yield situation and also how the framework in the US, the political landscape evolves. For me, the biggest surprise was the Russian index. Over 2 months, we have seen 23%. Year to date, we are still down. The Russian market, as you probably all are aware of, is measured on Shiller P, extremely cheap. If oil were to continue to go above 50, I would argue that the emerging market complex as a whole, and within it, Brazil and Russia will continue to perform at least in line with major Asian economy, maybe even outpacing them. With that, I'm already coming to the conclusion to give you room for questions. I believe a pullback is overdue. I hope it will happen somewhere between February and May, but obviously I don't have a crystal ball. But if it were to happen, central banks globally and in particular the Fed will step in. Rearrange your portfolio. So I'm personally very cautious for the Eurozone, for European assets. I therefore prefer Asian emerging market and US equities, and the same holds true for bonds, corporate bonds from that area. I said it before, we are not investing into local currency bonds, but assuming that the dollar is going to weaken further, this gives you two sources of return in local emerging market bonds. A, you will have a high coupon and you will have a currency gain, and maybe if we are really going out of this recession and have a cyclical recovery, a bit of spread tightening. Spreads will not tighten most likely in the corporate area. So you have to live with the running yield of 3.5 to max 5%. In a double B area, you go a bit lower, obviously you get slightly more return. Down the road, I would expect an euphoria, an asset bubble. It is hard to impossible to foresee when that happen. Over the next 12 months, so 2021, most likely this is not going to happen due to all the stimulus, the announced ones and the expected ones. For an insurance, I would consider gold. You can, if you believe that there is a strong rally in a strong recovery, maybe the better wording in the global economy, you can consider industrial commodities like copper, maybe iron ore. Last but not least, I must really stress, and I have said that before, so sorry to be like a parrot, but basically all assets are expensive. There is no value case here. Probably if you invest in cyclicals, in small caps, maybe selectively in value stocks, you get a better value than in growth and momentum, but momentum and growth are most likely to continue to do well. It is key to see that the fiscal cliff in the US at the year end is not going to happen. Therefore, watch out that we see over the next days an announcement of a fiscal package. My strong belief is that all this money printing, this modern monetary theory, so the monetizing of debt, all this fiscal stimulus will cause a melt up in financial assets. I do hope we see it in some shares. Nikola is a good example. Once it was announced that there will be no merger, no capital injection from GM, it dropped really dramatically. Tesla is another example. It's a great story, a great car, a global growth story, but at the same time, if you exclude the money they get from the CO2 compensation, they have never earned money so far. So Tesla is another example of overvalued asset, of euphoria. What is promising is that the FANG stocks have consolidated. Most of them are slightly down compared to levels we have seen 2-3 months ago, and the rally was broadly supported. Therefore, the most likely outcome is that this monetary stimulus and fiscal stimulus will push prices higher up, and therefore I would not lean against it. With that, I have covered my main message.
So we do have the possibility to answer the questions. So I will ask all the participants to leave their questions into the following section. Actually, I have one question on my side. So it is time to think about the consequences of the pandemic. Now, new reality, right? We are in lockdowns, working in an absolutely different way. We have new participants at the market, lots of new retail investors, which you mentioned additionally. So do you see maybe some changes in behavior of the markets? What kind of things could be expected? Because there are kind of like some rules for instance, sale off and others for Christmas, for instance. So what kind of things do you expect to be arranged in a different way in next quarter or something?
That's really a great question, and I probably could talk an hour about it, but let me try to get some key arguments. First of all, depending how you measure it, but the lockdown affects between 5 and 13% of GDP. That means if you really lock down, you close cinemas, you forbid concerts, etc., etc. All these companies are not on a stock exchange, so the impact on GDP is limited, and the impact on the market is limited. However, the key element is what you have put in your question. We see what I call a disruptive economy, or you can call it digitalization, which has gained speed, and it has various aspects. First of all, a lot of different companies, services are now demanded. I mean, the latest example is DoorDash, or in Germany, HelloFresh. I mean, basically, they are delivery services for certain goods. They have values for, I don't know, tech companies with a tremendous growth. If you look bottom line P&L, it is amazing how little it is. And now the question is obviously why. We see that the markets are moved similar to 1999. Sorry for that, I'm a bit older. But it is moved by retail investors, and in some particular area, I gave you now 2 names, Tesla is another one, Nikola is another one, and the price finding is not done by institutional money, it's rather done by the Robin Hooders. And this has tremendous impact on movements of the market, on volatility in these stocks, not in the broad market, but in these particular segments. And therefore, I would expect more euphoria in that area. I already have seen some alarming signals that, let's call it young retail investor YouTubing, what great stock selectors, what great managers they are. This sounds very, very familiar to the last big bubble in the tech bubble. However, the amount is not yet so big. And there is one big difference to the 1999 area. Besides the stocks I mentioned, funds and with it the global tech sector, they are all profitable. They also profit from the digitalization. And there are people who believe that the change in the technology is similar to the disruptive character of the 20s in 100 years ago. And we all know what happened at that time. There was a tremendous party after the pandemic, after money printing, after the technology development, which ended in tears. And there are people who say there are similarities. Obviously, you cannot compare a steam machine, electricity, telephone instead of telex, etc., to what we have now. But at least the change of how we work, how we function, as you can see here in the background, I'm somewhere at home, I'm not in the office. I can do basically everything I do in the office at home because the technology is in a way that at least for things you don't need to be like somebody who construct, obviously cannot do homeworking, but most things we do with our head can be done in any place in the world. And this has huge impacts, and this affects the markets, this affects sectors, and it will probably boost the growth over the coming years. And last but not least, I've said that before, I believe every bull market must end in euphoria, and we probably see some signs of it, but not yet so much that I would urge people to go out of the market. It was a long answer and I could go on, but I hope I covered at least the main points.
Oh, this is the question which is probably rolling to the head of lots of people. Additionally, while I'm thinking another question, what are your thoughts about new behavior after the financial action of US? That's our last seminar. Have you changed your strategies or added some things?
Let me give you an example. A client of mine told me recently, how is your outlook? Are you still bullish? And I said, well, actually, I'm still constructive. However, I have changed my intonations. And the reason why he said that is also obvious. He has parked his money in cash, which I fully understand. But if you see at the returns of corporate bonds, which a particular person normally invests, or even equities, obviously there's a huge opportunity loss. Forward-looking, the low-hanging fruits are gone already for years, but forward-looking, most likely you will see higher markets in emerging markets. You will see decent returns in emerging market corporates, probably in sovereigns. And then, only then, it comes the US. And last, in my understanding, in comes Europe. Europe has a huge problem, structural growth. For the first time, I must, however, add the ECB with his rescue fund goes into the right direction. But when I see what, for instance, Spain said what they are going to do with the rescue fund, basically they finance their normal budget, and this was never the purpose. So probably the effectivity of this stimulus will be very minor. While China, had first the pandemic, dealt with the pandemic, and then only then started with fiscal and monetary stimulus, and now is really accelerating. You see that also in the export statistic I've shown, and funny enough, not only goes to Europe, but also it goes to Americas, North and South. So real-time data tell us that we are at the early stage of a business cycle recovery, and the elephant in the room is the pandemic, how much impact it will have. So far, markets neglect it. So far, market price in the future, which assuming but not knowing there is a very minor third wave is fine. But the risk is obviously that the third wave will be significantly higher and we will have more lockdowns. But at the moment, I would say that's not in the cards, or at least not in the soft indicator, not in the behavior of the market participants. And we don't know how this vaccine really will work. So if we can extinct the virus, but if we were to see roughly 60% getting vaccinated, you get this outbreak more than under control. But that's the big question mark in the room.
True. Do you expect another black swans in 2021?
If I were to know that, my clients would tell me you would probably be skiing now. But I mean, I definitely would say we need to see, well, we need not, but we must expect to see a severe correction, so more than 10%. On the equity side, maybe 20, and if that were to happen, obviously you will see spread widenings. So from your 4%, you might get to 6%. That is good when you buy new bonds, but in the meantime, obviously, this will hurt the portfolios. But as Ray Dalio puts it really nicely, cash is not really an alternative, because cash holding is not for free, doesn't give you any return at all. And depending a bit on the currency, you have really other risks. If he's right that the Asian bloc as a whole area, knowing that India is not China, not Pakistan, etc., etc. But if this area were to continue to perform economically well, probably the dollar loses value, and the euro, although gaining value against the dollar, is also losing against emerging market currencies. And last but not least, I'm not an expert in ruble. You know that probably much better than I do, but your currency had a tremendous run over the last 2 months.
It was crazy, really, I should say.
Agree. But as an investor, it is a windfall profit if you think in dollars, as an example.
Exactly. Thank you so much for your comments. I think we will think more about our new topics in already next year, thinking how it will move later on. I don't see other questions in the charts, so probably we'll leave it like this. So would you like to make some comments to the participants, maybe some comments from Blackfort, or kind of like
well, first of all, I know people hate positive news. It's something I don't understand. I know if I would tell you that we were to go to see a crash, a huge third wave, this gets more noticed. So I'm really sorry to a certain degree that the message is a bit boring, but I would say it's promising. It's not so dark like the forecast from the economist side. And yeah, we wish all the participants well, nice festivities, be it in the Western time at Christmas, or be it in your time zone a bit later. And there are other festivities over the year end for other areas of the world. So all the best, and let's cross fingers that we see a prosperous 2021.
Exactly, and let's face the new, absolutely new year in new reality. We'll see. Well, thank you very much for joining, and thank you for presenting such interesting presentation. We'll share it with the participants who would be interested to have a read. It's really very profound. Wishing you all the best for the holidays, and please take care. So let's see you in the new year.